Hello, this is TK Kugler from Wasabi Ventures Stallions. Thank you all for coming tonight. We have a really interesting topic tonight, and one that we're going to talk a little bit about private equity in general, and then we'll talk some specifics about the topic at hand, specifically about stallions. But there's a lot of general private equity, venture capital, alternative asset discussion tonight as well. So hopefully you find it really fun. And I'm going to go ahead and share my screen and share the screen. All right. So we're talking about portfolio construction tonight. Um, as always, legal disclaimer, we are a financial institution at Wasabi Ventures Stallions. We are an investment uh, regulated by the SEC. So we have all those disclosures that you always expect, that we're going to talk about forward-looking statements by looking at past statements, situations. So none of those necessarily predict the future, and you should uh, do all double checking to all the numbers and all the thinking that I talk about. And nothing that I talk about tonight is a solicitation for you to invest. So just to be clear. So let's start with understanding the basics of Wasabi Venture Stallions. And for some of you who have been to our past webinars, this is going to be repetitive, but we'll go quick. We're a venture capital style alternative investment fund where all the assets are thoroughbred breeding assets. And all of our funds are annual 10-year funds. So it's going to be very important to understand as we talk tonight about a portfolio and portfolio construction that you understand the concept of a J curve. Once again, for those of you who have attended other webinars of ours or have listened to some of our educational materials, we talk a lot about the J curve and how it works. Just a brief thought about it is that all private equity, all venture capital, you sort of have those early years in a fund, and you're investing in those years. And obviously, when you invest the money that investors have given you, that goes down, right? The money goes out the door, and then you hope those investments appreciate, get returns, and that makes it go up. And obviously, if you think about that, it creates that J that we have demonstrated here in this little imagery. We're going to talk a lot about the J curve tonight. But what you want is you want as shallow a dip as you can get if you're constructing a portfolio, and as skyrocketing as you can get. So if you're teaching penmanship in the perfect world, this goes straight up, when it hits a certain point, right? And you don't want it to go too deep because that means you're losing money through those years. So we're going to talk a lot about the J curve, especially around portfolio construction tonight. So key elements of portfolio construction. There are lots of different types of funds in the private equity venture capital world. You could have a late stage venture capital fund, which acts very differently than a seed stage venture capital fund. The timelines and horizons in those two areas are very, very different. And in some funds, there is no distributions. You don't get distributions until the fund is almost nearly done, right? Because you got to wait for all of those assets to appreciate. At Wasabi Venture Stallions, we're a little different in that we really concentrate on DPI as one of our key metrics. And if you don't know what DPI is, that's distributions back to investors. And we had a whole webinar on these terms just a few weeks ago. So feel free to look up on our YouTube channel for that. But to construct a portfolio, if you're thinking about DPI and total returns for the fund, understanding the individual assets and when they return, when they create returns, is very, very important. And we'll talk a lot about the different assets and when they return and why we construct a portfolio the way we do. But this third bullet is probably the most important bullet I'm going to mention here, and that all private equity, all venture capital, which I have spent my whole life in, and all alternative assets, every single one that I can think of, is about access, access, access. It's not useful if you just have money to invest, because just having money will not get you access in almost all cases to the best investments in the private world. This is not like going to the stock market. You don't open up your Schwab account and start buying stocks, which frankly anybody could do. This is very different. This is getting access to assets that you are invited to only. And we're going to talk a lot about that when we talk about portfolio construction, because it is our expertise and our professionalism over the last 6 years. And I see George Adams is on the call. And it's the talents of George, and the work that we've done and the previous portfolios that we've built that actually get us access today to the best stallions and in many ways the best mares. And so we'll talk a lot about that tonight, but it is very important to understand that without the best mares, you're not getting access to the best stallions. The stallion farms will not ask you to buy seasons. They will not ask you to buy breeding rights. You have to have those mares, or you're not getting access. And that's an important key point. And that really, once again, to expand your knowledge across all of this sort of private equity world, that's the way it is in venture capital. Just having money to invest rarely gets you to the best deals. It's what else can you bring to the table, and what kind of investor are you, means as much as how much money you have. So let's talk about, there really are two assets. There are broodmares and there are stallions. Now there are levels and there are types, subsets, if you will, in between, but we're really only talking about two assets. And for the biology out there, once again, we're talking about breeding assets, right? So you can't have breeding without females and males. So, and so the broodmares are the females and the stallions are the males. And those are the two assets that we're talking about. All of every portfolio we have, we're getting ready to launch Fund 6 in the next couple of weeks. But the first 5 funds that we have are all made up of some combination of broodmares and stallions. So let's dig in and talk about broodmares specifically right now. And for many of you, you've seen this chart before. I've used this in other times, in other webinars and other educational pieces. This is a sort of heat map, if you will, of when a particular asset is predicted to generate returns for the fund, when it is most likely. The deeper the orange, the brighter the orange, the more likely it is that it returns in those periods. The paler, the less likely it is that they generate returns. So if you look at broodmares, you'll notice that broodmares have the best chance for our funds to return early in a fund's life. Okay. And why is that? Because, first of all, if you understand the breeding cycle of thoroughbreds, it's an 11-month gestation period. So sometimes we buy broodmares who are already pregnant, so we jump that. We'll get our first asset, which is a foal, um, that she produces, and we can sell that. That's how broodmares generally return their they make returns, right? They make their returns by having the foals, and then you sell those foals at an auction or in a private sale or whatever the case may be. And um, that's how they generate returns. That is early in the cycle of a fund because you literally, in the very first year, could buy a broodmare who's already pregnant. We could put it into a fund, and that foal could be born 4 or 5 months later. And we could, as soon as 10 months later, sell that full. Um, Very short time window. So in that first year, it's possible that it generates returns and therefore uh, adds liquidity to, remember, once again, we like to concentrate on that DPI. That happens. In some cases, we also rent that mare out to someone else who's breeding them. That can generate a mare rental, which also can happen very early as well. So that's why brood mares, once again, and we're going to talk about this in more depth later, they return early. They can return early, and when we'll talk about stallions, you'll see that it's a little spottier early. Um, so if you're thinking about a portfolio construction, there's a lot of value in having those brood mares to some degree and at some percentage in a fund because that's probably your best bet of returning early in sort of the in those first 5 years, 5, 6 years, if you look at this chart. We'll talk more about stallions here in a second, but the other thing, do not lose sight of the access piece. If we do not have quality brood mares, we're not getting to buy into stallions. So the two do have to work hand in hand. But from when a broodmare returns, it's early. And you might say, well, if she's successful, wouldn't she return late? Sure. But many brood mares, especially we buy emerging brood mares in emerging families. Once again, we're trying to find value, buy low, sell high type of situation. So some of those are going to miss, right? That's just the nature of it. So the chance in the later years that they're returning is less. So that's why I color it this way for you. Let's talk about stallions, on the other hand. The stallion market is very interesting. And you'll notice that the colors kind of jump around. It's not as consistent as some other things. You'll notice that there's no chance of returns in year one. Um, and the reason I put that as no chance is that I'm really showing that if we buy a freshman stallion, someone that is if a stallion asset's brand new, sometimes we are able to buy on a secondary market and we get an existing stallion, so we could get returns in that first year. We bought a McLean's Music or an Army Mule or historically a Jimmy Creed or a Dialed In. Well, they could return, but I'm specifically talking about, which is the majority of what our assets are that we purchase. They're brand new stallions that first year. In the first year of a stallion season, um, once again, they'll cover. They do not generate any revenue back to the fund, no income to the fund until those first foals hit the ground. So if you think a whole year forward, so if we buy it in year 0, it covers in year 1. By year 2, the first foals hit the ground, and as long as they're healthy and survive, we get paid at that point. And that first year is usually one of its best years, right? The way the market works is year one is this is an industry that's all about the dream, right? So in year one, people will pay a premium, they'll pay full price for that year one stallion. And so that's why I color that in bright orange. By year two of that, once again, so it would cover here, we would get dividends. They're almost all stallions are almost getting discounted there. That almost all of them are getting discounted. And by year three, it's really hitting the trough. They really get discounted. And in some cases, that season may not even get used. So there's no income sort of generated in those windows. That's why the colors get pale here. By year five, you start to see horses hit the racetrack. And if those horses from way back here, those foals, are successful, that's when you start to catch lightning in a bottle. If you go back and look at on Fund One for us, Honest Mischief had a really big year of its first year. All of a sudden, lots of people want to breed to Honest Mischief. And so we were able to sell 3 seasons. It's going to generate a significant amount of income for Fund One because it was successful. But here in these windows, we couldn't give away an Honest Mischief season, right? And nobody wanted them. And so that's just the normal cycle of a stallion. So if you're thinking about your fund and your construction, if broodmares can start generating income in those early seasons, and stallions tend to be spotty, but you're looking for big returns when you hit at the end of a fund, you allow yourself to create a J curve that sort of flattens out here. And that's really what we're talking about, okay? And we'll see some more images of that. But that's how these two sort of work differently as far as when they can generate returns for a fund. What's the ideal portfolio of a fund? So I put this in asterisks, because it's not perfectly ideal ever, right? Because every year is a little different. Some years you have really strong stallion classes, and you want as many of those as you can get because there's a whole bunch of them that are interesting and that we find that are going to be interesting and we hope generate value long term. In some years, there are very few. So you might have slightly more broodmares than you have stallions. We also, in funds 3, 4, and 5, those were our first funds where we had broodmares at all. We started adding broodmares because our funds got larger, right? We started investing more money. Broodmares are the trick to having broodmares is that they carry expenses. Stallion seasons can too, but they tend to be lighter expenses in many ways because you're carrying more broodmares. So you have to balance that of your fund construction. I can tell you for Fund 6, we are shooting for this ideal portfolio. We pretty much have all the broodmares that are going to be in the fund already. We bought a few, and they're in Fund 6. We'll do a talk. We're going to do a kickoff for Fund 6, and we'll talk about the assets we already have and all of that at a different time. But I can tell you in Fund 6, we're really shooting for this ideal where they're 20% broodmares, 80% stallions. And those percentages, just so everyone is thinking about this correctly, I'm thinking about the raw full cost of that. So if you buy a $200,000 stallion, and you buy a $50,000 broodmare, but the $50,000 broodmare has, $40,000 expenses, 50,000, we'll just round it. So it's $100,000, you could get 2 broodmares and 1 stallion for that, so it's raw dollars that I'm talking about here, just to be clear, as far as AUM for the fund. But this is the ideal. This is what we're shooting for in Fund 6, and hopefully we'll see how the future years go, but that's how we're looking here. So let's go back to that J curve. Okay. So if you go back to and you think about, we talked about broodmares and that, this is kind of the J curve that we shoot for. We shoot for a shallow J curve, very shallow for years 0 through 5, and that we're hoping by year 5, we're getting very close to that even point, and then we can start seeing positive returns. So this is what an ideal J curve looks for us, and that is with the combination of the broodmares and the stallions there. So like Fund 5 that was last year is currently just starting year 1, right? Year 0 is the year we raise it and deploy it, and we deploy it mostly at the end of the year. So we're in year 1 now. So 5 years from now, we're shooting for that Fund 5 to be back to its break-even point, and then it starts hitting the returns. That's kind of how we look at these things, and that's the ideal J curve. And really, just to be clear, we're looking for this kind of multiple too. It's kind of we're our dream here is this kind of multiple in the later years. That's how private equity works. That's why you invest in alternative assets along the way. I think it is important though, and many of you are investors. I see you on here have been investors in other funds. You are getting DPI through these years. We literally are trying to return all of your money back by year 5, so that once from there, that's when the sort of so-called white meat starts hitting, right? That's where the good stuff starts coming, the gravy on top of the white meat, I suppose. So, but that's kind of the ideal curve that we're looking at. Okay. So that's how we think about portfolio construction. That's why we've been asked many times. I've been asked a bunch of times over the last couple of years when we started adding broodmares. Why did you add broodmares? Well, I hope you understand now that if we didn't add broodmares to the funds, we would not be able to get to the stallions that we currently get to. It's one of the reasons why funds 1 and 2 are very heavy in sort of LBRs and stallions that are sort of in that $10,000 range, where we're now investing in assets that are 40s and $50,000 for per season now. So it's given us access to situations that we couldn't have possibly gotten before. I'm happy to take any questions that anybody has. I see people typing. I'm going to give them a second. While I'm giving people a couple seconds to ask questions, it's interesting pulling from my past life and sort of in the venture capital world. It's most of the funds that I've been a part of often do not return their full fund until year 7 or 8 or 9. Just to give you a sense of how it's different here. So when I think of returning by year 5, I think that's pretty amazing. Sure. Amy Kelly asked, or Amy K, I think it is Amy Kelly though. Are you able to explain to the group the difference between a stallion share and a lifetime breeding right, since they've been these references in the first 5 funds on the website? Yeah, sure. We'll talk a lot about that in the kickoff of Fund 6 too, but it's a good question, and we have a couple of videos dedicated to this on our site. and on our YouTube channel. But I'll do that here for you. A stallion share is exactly what it sounds like. There are usually 40 shares in a stallion. Just think of it as a company. Stallion is a company, and there are 40 shares of it. So you literally, legitimately own 2.5% of that stallion if you buy one share. And if you own one share, if that stallion makes money, it's called a pool, and you get your 2.5%. They declare dividends when that happens. The interesting feature also with a stallion share, unlike a company, is that you get a breeding right that goes with it, meaning um, sometimes it's one, sometimes it's two, it could be others, but you have the right to send a mare or sell someone else the right to take their mare and breed that to that stallion, and that generates income for you. Okay, it's basically think of it almost like a coupon on an old coupon bond, right? You sell that. So like this year, I think Army Mule is going for 20,000. Is that correct, George? Yep. So we have the right to sell in Fund 5. Fund 5 has the right to sell one $20,000 season and generate $20,000 in income for selling an Army Mule season. That's what a stallion share is. A lifetime breeding right um, uh, is just like what I just described. You get a breeding right per year, sometimes two, depending on how it's structured. And you can sell that every year, just like I just described, except that you do not actually own the stallion. You have no rights to dividends. You have no rights to really anything. It's just basically a breeding right that goes in uh, perpetuity, really. As long as that stallion is never sold or, you know, whatever, retired. So, um, and that's kind of how that works. Okay. The industry has moved pretty heavily to shares. And moved away from breeding rights. You only the breeding right thing is kind of moved away in the last few years. And the only breeding rights I really generally see are either on the secondary market or in sort of lower level stallions. Um, so hopefully that helped. David asks, it feels like broodmare is owned by earlier Wasabi funds because it's to exit in future vintage. Am I thinking about that right? So there's a positive snowball effect. Absolutely, David. The outside world thinks of Wasabi Venture Stallions as all of the funds collectively, right? So if we have a really great broodmare in Fund 3, right? Um, so she's a broodmare called Gunsling, and she's a sister to Disarm, who was on the Derby Trail last year and is one of the better older horses in the country. And by having that one, our reputation sort of helps. But so it definitely does help that reputational and access element 100%. Um, Amy asks, for any stallions the WV has in the funds currently and the WS will not be using to breed their mares to are these breeding rights under stallion share going to be sold to someone else? Absolutely. George actually works really hard on trying to sell those. He's last year I don't know the exact number that we sold across all of them, but let's say 6 to 10, somewhere in that range. And he's already gotten contracts on a handful already so far this year, as well. So absolutely 100%. George sort of is out there peddling them for us in the secondary markets. But yeah, 100%. And the fact is that the vast majority we don't use, right? Because we're also in sort of those trough areas when we have stallions as well. So we have to protect the mare as well. So because the mare is an asset as well. So you're going to want to breed those mares to the most appealing market wise stallions that you have. But we absolutely sell those. It's a good question, for sure. It's one of the great, I will piggyback off of what I said. It's actually one of the great benefits because the asset stays there with you, right? Honest mischief, I'll bring that one back up again. The last, the last 2 years prior to this, we had that honest mischief share, and it's a full share from Fund One. We could not, no one was breeding to honest mischief. No one's an exaggeration, but did not have the fervor that we got this year, where we were able to get three. Correct, George? I think we wound up selling three seasons to honest mischief this year. So just goes to show you when you get to that tipping point, that year 5, year 6 sort of time window, that's when you hope you hit magic and you see those things happen. Any other questions? Good questions too, by the way, tonight. Really, really thoughtful. I will just sort of on closing, and in case anybody does ask anything else, just uh a sneak peek for all of you. I think Fund 6, we're looking probably the first week of March that we're going to open it, and we're going to do a webinar, a kickoff webinar like we do every year, somewhere in that first week of March, where we'll talk about past funds, we'll talk about the fund structure. For some of you who have invested in the past, it'll be a repeat, but there'll be some and then we'll talk about the assets that are already in Fund 6 and some of the things we're thinking about for Fund 6 this year. But I think we're going to open that up in the next few weeks. But you'll hear some announcements about that. Super. Any last questions? All right. Well, I thank you for coming tonight. I appreciate it, and I hope you enjoyed this one as